Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome to Module 4, Forex Expert, Lesson 1, Economics and Forex. This is the agenda for today. At first, we will talk about some of the economic indicators which are relevant for us, not only for the Forex markets, but also for other assets. Then we will go into some of the economic indicators and investigate them in more detail. At first, interest rates, central banks, in specific the US Federal Reserve, the Fed, and interest rate cycles. And lastly, we will cover the so-called carry trade. In general, we can say that strong economies have strong currencies. So the stronger the economy, the stronger the currency, and the weaker or more uncertainty there is about an economy or a country, the lower the value of the currency. There are many examples of this today. The best and most recent case study I can use to transfer this into the charts is the Brexit case study, looking at the British pound. This case study shows two things really. Number one, the uncertainty around Brexit and how Brexit would impact the UK's economy led to a volatile crash of the UK currency, the British pound. Therefore, the price of a currency is in line with the current and expected future health of a country's economy. And second, this case study will show that these news events move price. And while some may say it is unknown where price is going to go, price was just going where it was going anyway in terms of momentum and higher timeframe supply and demand context, only faster. In this case, a lot faster. So here's a headline of the 23rd of June 2016. Britain goes to the polls to answer the question, should the UK remain a member of the EU or leave the EU? So let us look at the charts going back in time and check what the supply and demand higher timeframe analysis would have told us to do. Either the higher timeframe context in terms of location and direction will tell us to go long, or it will tell us to go short. Let's start with monthly location, with current price being the 23rd of June 2016, the day of the Brexit event. We see a nice supply area, drop-based drop above current price. The first fresh monthly demand is a lot lower. Right here, a level on top of level. What else do we see? We can see a clear neckline, support neckline, the dotted line, and a higher time frame head and shoulders setup. So if we go lower, we could even go as low as the all-time low, the drop base rally. Let's look at direction. This is very clear. We can see a high, a lower high, a low, and a lower low. 4 out of 5 confirmed pivots. What does this tell us? Anticipatory downtrend, really anticipating another lower high to be formed. And if another lower high is going to be formed within higher time frame supply, then we would expect another lower low to be formed as a result. Remember, trend is price going from higher time frame supply to higher time frame demand. So there is space until the first monthly level on top of level. Let's now look at a lower time frame to see if we could have pinpointed this move and set a trade. First, the weekly charts. There's a supply right here, but really only visualizing supply. Let's go refine on a daily time frame. What we see is a nice daily drop-based drop, actually even maybe a level on top of level on a daily. So what is our general bias when looking at the British pound on a higher time frame as well as a lower time frame? We want to be a seller, right? So let's play this out. What do we see? Brexit playing out with a large move to the upside first, and then rejection and sellers coming in once price was trading very high, and ultimately price is creating a lower high and therefore a confirmed downtrend. As a result, we get a lower low. Now, did we know that the UK was deciding to leave the EU? No, we didn't. Even if we did, would we have known the effect it has on the currency? That's subjective as well, right? Someone who's voting pro-Brexit may think it's a good thing for the currency and therefore they may be buying. What really matters are the charts and the higher time frame charts, because this is how institutions and big banks position themselves. And arguably, even without Brexit, the British pound would have made lower lows, as this is what the direction analysis told us. However, it would have made this not as fast. Now, economic indicators are really fundamentals. Fundamentals like interest rates and monetary policies have a direct influence on capital outflows and capital inflows of a country and economy, and therefore will cause an imbalance of supply and demand. Economic indicators affect economies and therefore also influence the value of our currencies. In this Forex course, we will look at 4 economic indicators in more detail. Oil prices and how oil prices do not only have a long-term relationship with the overall global economy, but also with certain countries, in specific countries like Canada, which is a big oil exporter. Therefore, the price of oil influences the value of the Canadian dollar. We will look at gold prices, which we know are priced in the reserve currency, the US dollar. And as a result, the value of the US dollar index influences the price of gold. But also, gold is known to be a safe haven asset. So we will compare gold to other known safe havens like the Japanese yen and see if there are any long-term relationships, so-called correlations. We call this cross-asset market correlations, which we can use as an additional zone qualifier. We will look at central banks, what they do, and how interest rates affect currencies and economies, and therefore also equity indices. We will talk about carry trades, which is a strategy that looks at interest rates, deltas of 2 different currencies. And lastly, another economic indicator is the so-called inverted yield curve, which is a chapter on its own. In this lesson, we will just look at central banks, interest rates, and carry trades. Let's start with interest rates. Generally speaking, interest rates are a tool used by central banks to keep the economy stable. As we talked about in the US dollar index lesson, central banks have a job. They call this job a mandate. So central banks really have 2 mandates. And they can achieve these mandates by either lowering interest rates or increasing interest rates. Their first mandate is to keep prices stable and ensure their inflation targets are met. These targets are usually between 1.5 and 2% of inflation. And their second mandate is to encourage job creation when employment is low. How effective their methods are and what has been happening in the past few decades with central banks around the world following a zero and negative rate policy is a completely different topic and something we have to talk about at a later stage. Talking about terms like the zombification of economies and the Cantillon effect, meaning the expansion of the wealth gap. First, let us talk about their general mandates as per the textbook and how they would try to achieve these mandates. Historically, whenever unemployment was low during times of economic recessions, the central banks would go ahead and lower interest rates. They have done that during the dot-com bubble of 2000 and the housing crisis of 2009. Really, what you will be able to observe are interest rate cycles. During times of uncertainty, a central bank would start lowering interest rates. What is going to be interesting when we look at these interest rate cycles is that usually central banks will start lowering interest rates at the peak of stock market index prices at all-time highs. So when they lower interest rates, what they really do is they ease the access to capital and ability to borrow. Basically, borrowing money is going to be cheaper, which means more people will borrow and spend money, which in turn creates jobs. So we know that our economy today lives from the access to capital and ability to borrow. If you can't borrow, it really squishes an economy. Banks in general help to promote this. When you deposit money in the bank doesn't just hold on to the money waiting for you to come for it. They actually lend it out. But the reserve rate is only 10%, which means they can lend out 90% of your money to someone else. So let's say you deposit $10,000 in the bank, they lend out $9,000 of it right away and keep the $1,000 as a reserve in the vault. So here's the amazing dynamics. When Mr. A deposits $10,000, the bank can lend out $9,000 to Mr. B. And once it hits Mr. B's account, they can lend out 90% of that to Mr. C, which means just one $10,000 deposit can create $100,000 of new money in the system. This only happens if people are willing to borrow, and people are encouraged to borrow by lowering the interest rates. And if you don't want people to borrow as much, you simply just increase the interest rates. This is how the Fed controls the economy. When they want to speed up the economy, they simply just lower the interest rate, and this causes expansion of money supply because more people borrow, the more people spend, the more economic activities we have. And when the Fed wants to slow down the economy for a bit, they increase interest rates. This is how the Fed manipulates and controls the economy as per the textbook. So when the central bank increases interest rates, really the opposite happens. It means that less people have access to capital as loans become more expensive. As a result, there's less spending, and with less spending, prices will fall. The interesting part here again are the interest rate cycles. Central banks usually hike interest rates during economic recoveries and booms and bull markets. This is because a central bank have always seen interest rates as a tool to fight recessions and stabilize economies. Whenever there was a big problem, central banks would just lower interest rates. Now the problem is that this trend has become more and more extreme, and in 2009 the US Fed has lowered the interest rate to close to 0% for the first time in history, with the argument for this being temporary to help the economy recover after the big financial crash of the housing bubble. This was a textbook lesson on what central banks are supposedly doing. Now let us look at this from a different angle, really looking at the Fed, US interest rates and interest rate cycles, the US dollar and the US economy. An interesting observation is the US dollar and how the US dollar index has managed to increase so much in value even without interest rates going up. This has several reasons. First of all, the nemesis of the US dollar is the euro, which, as you know, has a massive impact on the value of the US dollar index. So with a weakening euro and euro operating within the zero and negative interest rate policy for decades now, the US dollar was just the cleanest dirty sheet. But also look at this from another angle. And this is something that took me also quite a while to really understand it and connect the dots. And to do this, you have to be a cross-asset market investor and understand the concept of supply and demand. So the Federal Reserve is the most powerful central bank on the planet. And they are not just a central bank, they're also a private organization, one that is allowed to own equity in form of shares or company stock or corporate bonds. So just picture the central bank doing the same thing as us: buy low and sell high. Now listen to this. Isn't it convenient that they're the ones that are actually allowed to also print the money when the value of the US dollar is high and sell it in exchange of securities? So in March 2020, when the US dollar was very high, trading at 102 within the wider version of monthly supply, they printed 3 trillion US dollars. Basically, the Fed created more supply of the US dollars and they sold it and they exchanged it for corporate bonds and securities, which were low at the time of March, right after the Corona crash, where equity indices had dropped 35% and more and were in monthly demand. They didn't just buy treasuries or other government certificates, no, they bought stock certificates, corporate bonds and stocks. Stocks technically through intermediaries like BlackRock, but it's the same thing. Here you can see SPY, which is the S&P 500 ETF symbol. In essence, what they did is they took a highly valued dollar at 102 and bought cheap equities, and now equities are expensive and the value of the dollar is down. So now it would be convenient to buy back the dollar and sell the expensive securities. The Fed has done the same thing in 2009, where they printed US dollars through the first QE. At that point, the US dollar was high in monthly supply. In exchange, they bought securities after the crash of 2009, buying equities very, very low. This is what you can see once again right here. The Fed printing US dollars in March 2009, creating supply of the US dollars within monthly supply and selling it in exchange for securities. Again, The SPY trading very low in monthly demand in March 09, even lower than after the dot-com bubble. And the Fed starts buying low, a lucrative business, right? Especially when you're the most powerful institutional player in the market. So we can summarize that the Federal Reserve is really an institutional participant, not just in the forex markets, but most importantly also in the stock markets. And we can assume that they look at similar, if not the same technical chart analysis that we're looking at. Like any institutional participant, also the Fed buys low and sells high. And when they intervene, it moves markets because they're the ones that can just print expensive dollars and buy securities in exchange. Looking back at this year, this is something we also underestimated this year, as we're now seeing stock markets divorcing themselves from the underlying economy, creating the biggest stock market bubble in terms of valuations we have ever seen in history, bigger than 09 and even bigger than 2000. So there are these interest rates that the Fed controls to manipulate the economy and the US dollar. More important than interest rates are so-called interest rate cycles. Here you can see the interest rate cycles from 1995 to today, 2020. You have the rate hike cycles, for example, from 1994 to 2000, where the Fed raised interest rates all the way up to 6.5%. Or from 2004 to 2007, where the Fed raised interest from 1% to 5.25%. And the last interest rate cycle from 2015 to 2019, where the Fed raised interest rates from 0.25% to 2.5%. What is clear and obvious is that this is clearly a downtrend, with the interest rate hike cycles becoming ever smaller and the interest rate easing cycles becoming ever bigger. You can see easing cycles from 2001 to 2004 with interest rates dropping all the way down to 1%. Then the next easing cycle started in 2007 and lasted 8 years. As you've learned in the first lesson of this Forex course, 2009 is really a historic turning point for the Fed because they had lowered the interest rate all the way down to 0%, actually 0.25%. And look at this, the interest rates stayed that low for a very long time, 6 years, until 2015, when they eventually started to raise interest rates. A poor attempt to go back to normal because in 2018, it became very clear that the stock markets have become addicted to low and 0% interest rates. They can no longer survive without it. And we will look at that when we overlay this chart with the SPY S&P 500 chart. Now here's the interesting part. Whenever the Fed decided to change its course from a hiking cycle into a new interest rate easing cycle, it predicted the recessions and stock market crashes of 2000, the dot-com bubble, 2009, the housing crisis, and 2020, the corona crash and the recession. Before COVID-19 even existed, yes, correct, the Fed started to lower interest rates, really going into an easing cycle back in July 2019. Back then, it was clear to us that a recession is right around the corner. The trigger just happened to be a virus. And the opposite is true for interest rate hike cycles. Whenever the Fed started increasing interest rates, we can see bull markets and booms and recoveries forming in equity indices across the board. Let's overlay this chart with the SPY, the S&P 500 ETF chart. The 1990s provided some of the biggest structural growth the markets have ever seen, not just in GDP terms, but also in terms of stock markets. During this time, the economy grew by more than 3% as an annualized average. In this time, starting from 1994, the Fed went into a rate hike cycle, raising interest rates multiple times all the way into the tech bubble, the dot-com bubble. At the peak, the interest rate was set at 6.5%. And what we can observe was real growth in the underlying economy and the stocks. Prior to the famous tech bubble bursting, the Fed started easing, lowering interest rates. This was a sign that the economy had run into structural problems that the Fed had also realized. And what you can see in this chart is a longer term bear market from 2000 all the way to 2003. In 2003, interest rates reached a low of 1%. And only in 2004, the Fed started to slowly raise interest rates again. This time, we cannot speak about a stock market boom, as it was just a recovery to the previous highs of the 2000 tech bubble. But the economy during this time still had structural growth, lower than in the 1990s, but GDP on average was still at a 2.4% growth during this time. The Fed had managed to hike interest rates all the way back to 5.25% in 2007. In the same year, however, the Fed changed its course and started to cut interest rates aggressively, multiple times, and with that also once again predicted that there were structural problems in the economy and that the recession is just around the corner. This was the well-known housing crisis. The markets tanked by more than 50%, even lower than during the tech bubble. And as a result, the Fed cut interest rates even lower, all the way to 0.25% for the first time ever. In the beginning, it was communicated as a temporary step to intervene and support financial markets, but it was anything else but temporary. The US stayed at 0.25% all the way until 2015. And only then the Fed started to raise interest rates, very, very slowly, with the attempt to go back to normal. This only worked until December 2018, when the interest rates reached 2.5%. The market started tanking to an extent that was last seen during the housing crisis of 2009. The S&P had dropped 19% in the matter of just 3 months. This was a signal by the financial markets that they did not want to go back to normal interest rates. This makes sense, right? Because at that time, corporate debt has never been higher in history. From 2009 to today, the markets have even outperformed the 1990s bull markets, even though the real underlying structural growth was pathetic compared to the 90s, with an annual GDP growth of just 1.2% as compared to 3.2% in the 1990s. So really what happened is that the markets had rallied on the heels of the increase of global money supply, low and close to 0% interest rates, and the increase of corporate debt. In July 2019, the Fed flipped their policy and decided to go into another easing cycle. Although this was not communicated to be an easing cycle, just a one-off interest rate cut. And just like 2009 and 2000, also the 2019 rate cut predicted a recession to follow shortly. The Fed lowered interest rates and lowered interest rates and lowered interest rates, and since March 2020, interest is yet again set at 0.25%. However, what we see now is a first in history. Never have we seen a global recession with asset prices trading at all-time highs, without any structural underlying growth of the economy. Actually, quite the opposite. GDP has been declining massively. So what is happening? QE, quantitative easing, central banks going all out, buying assets and thereby driving asset prices higher. Let's summarize. Interest rates has always been perceived as a tool for the Fed to manipulate and stimulate the economy, almost like a weapon to fight recessions. Whenever we ran into a problem, the Fed would just lower interest rates, which in turn would predict a recession for the proactive investor. The problem the Fed has now is that interest rates are set at close to 0%. So basically, they have ran out of ammo. So what is left? QE, which they started in 2009 for the first time, potentially negative interest rates, which we already see in Europe, Japan, Sweden, and Switzerland, and at some point also helicopter money. This is the last topic for today. We have already talked about the carry trade in one of the first lessons. The idea of a carry trade is to carry a longer term wealth position, where the interest payment on the currency you are long is greater than the interest expense you are carrying on the currency you are short. The strategy is fairly simple. Some of the currencies have interest rates attached to them that are very high and others are very low. And we want to buy currencies which offer high yields or interest rates. And we want to sell currencies which offer low yields or even negative yields or interest rates. And the bigger the difference in yields, the higher the daily earning potential through rollover. So let us say we buy a currency that has a high interest rate. That's our long position. And our short position is a currency like the yen, or in these days, just about any currency, even the euro or the US dollar, that basically doesn't cost you much. As long as the amount we are making for the long is greater than the amount you are paying for the short, you make money. You could break even and make money. It is basically like dividends in the stock market. The carry trade is really a longer term wealth trading asset strategy and perfect to look at for monthly income trades. We generally use carry trades to increase our earnings potential, while the trade execution is always based on supply and demand. Now this works well because of the leverage effect. This is the most important part of the puzzle. The interest that is being paid is not based on the margin, but on the trade value. Now here's the catch. The problem today is that interest rates globally are very low. So this is something worth noting for now. And as some central banks may start raising interest rates, you could capitalize on that by using this. Most currencies that have a high yield today are currencies from emerging markets like Mexico or Turkey. In these scenarios, this strategy wouldn't work because you would go against the overall trend of highly devaluating and weakening currencies. So it does not make sense to buy the Mexican peso long term, because we would lose on the long position. So the idea is to combine supply and demand with a carry trade, which today is very, very difficult to find. But sometimes, during certain times, like during the Mexican presidential election, for example, we can buy the Mexican peso. This is something we will look at later. To drive this topic home, let us look at an interesting case study. An example from the year of 2018, which we shared in the 2019 Forex course. So this should ring a bell to you if you are one of our veteran students. Back in 2018 and 2019, the US dollar interest was still set at 2.25%. Therefore, if we are going long the US dollar, we're being paid an annualized 2.25% a year. And shorting the Swiss franc, we are also being paid an annualized 0.75%. This is because the interest is negative. So shorting a negative interest rate currency is a double negative and therefore a positive. The difference is 3% annualized. And as per equity, this was $6.70 per standard lot per day. So buying USD CHF at daily and weekly demand and holding it for 41 days meant we made $275 per standard lot on just the interest, assuming we traded this with one standard lot. Our risk for this demand zone was $442, making $275 on interest is almost paying the risk for that trade. So even if we were stopped out at break even, we would have still made money. The learning here as well is that this is obviously just 41 days, so not really long-term wealth, and that this is just an additional tool to make money. The most profits, however, is still made with the right setups and proper risk to reward ratios. Today, the interest of the US dollar is at 0.25%, so this also does not apply to today anymore. Alright everyone, this lesson is crucial to understand a lot of recent events that are happening in the financial markets. We're stepping into unprecedented market conditions, so navigating within the financial markets, it is key to understand the participants and their impact on the markets we trade. In the next lesson, we will look at crude oil and gold. I will catch you all for the next lesson. Thanks everyone, and until then, happy and safe trading, and ciao.